Zen Technologies is generating some massive buzz in the defense sector right now. But we have to ask, is all this hype actually justified? Today, we're cutting straight through the noise. We're going to weigh their tremendous growth potential against some hidden, absolutely critical risks that every investor needs to understand.
Here is our roadmap for today's explainer. First, the massive order book. Second, expanding beyond simulators. Third, the FY26 reality check. Fourth, the bull versus bear case. And finally, the final investment verdict.
Just a quick note before we really get going. This explainer is brought to you by TopX Wealth and Insurance. They focus on helping you navigate complex market opportunities objectively to protect and grow your wealth.
And hey, if you want to dig deeper into this specific strategy later on, you can reach out directly to Chief Consultant Stephen George using the number provided, or you can track them down across social media.
Section 1. The massive order book, a foundation of growth.
Okay, let's talk about this staggering number. As of March 2026, Zen Technologies is sitting on an order book of 1,336 crore rupees. To put that into perspective for a second, that is roughly double their entire annual revenue for FY26. We are literally talking about 3 to 4 years of crystal clear revenue visibility driven almost entirely by the Ministry of Defense.
So where exactly is all that money going? Well, it's split perfectly down the middle. 50% goes to their traditional training simulators, and the other 50% is for highly relevant anti-drone systems. But here is the real secret weapon for their financial stability: an additional 336 crores locked into annual maintenance contracts. That means reliable, recurring revenue.
The momentum here is honestly explosive. In just the fourth quarter of FY26 alone, they secured 431 crore in new orders. Think about that for a second. One single quarter completely crushed their entire order intake for the previous fiscal year. And the contracts, they just keep rolling in. In April 2026, they bagged another 404 crore.
Section 2. Beyond simulators, expanding their tech footprint. Zen isn't just building basic training tools anymore, guys. They are stepping straight into the realm of sci-fi. We're talking AI anti-drone systems, unmanned ground vehicles, directed energy weapons, and combat robotics. It is a massive strategic leap into high-margin tech. And they are aiming incredibly high, targeting a 4,000 crore order book and 35% EBITDA margins by FY28.
Section 3. The FY26 reality check. Promises versus execution.
Now, despite that massive billion-rupee order book we just hyped up, the actual on-the-ground reality is incredibly stark. When you compare FY25 to FY26, revenue dropped significantly, falling from 973 down to 687 crore. And consequently, profit after tax fell to 193 crore. That is an undeniable, heavy hit to their bottom line. And the fourth quarter of FY26, completely brutal. A 76% drop in revenue, a 69% drop in net profit, and a shocking 96% collapse in EBITDA. Naturally, the market panicked, and the stock crashed 14% in a single day. So, what exactly went wrong?
Well, the company blames this entirely on an execution delay, because a massive chunk of orders came in really late in the year, and let's be real, complex defense tech takes a lot of time to build. They simply couldn't convert those orders into revenue before the calendar ran out. So, what does this mean for you? It means the true test of their capabilities hasn't actually been failed, it's just been pushed to FY27.
Section 4. The bull versus bear case, weighing the potential.
Let's break this down. On the bull side, Zen is riding a massive wave of Indian defense indigenization while simultaneously opening up export markets in Africa and the Middle East to reduce their reliance on the local government. If they deliver, this stock could absolutely soar. But the bear case is heavy. You have severe execution risks, a sky-high valuation of 60 to 80 times earnings, which leaves literally zero margin for error, and a dangerous dependency on unpredictable government procurement cycles.
Section 5. The investment verdict, the final analysis. So here is your key takeaway from all of this. Zen Technologies is absolutely not a stable buy-and-forget stock. It is a high-growth, high-risk play. To navigate it safely, you need to use a strict, actionable checklist for every single FY27 quarterly report. Are orders actually converting to revenue? Are profit margins improving? Is cash flow healthy? And are they still winning new contracts?
We highly encourage you to follow TopX Wealth and Insurance on their channels to track how this story unfolds. But ultimately, you have to ask yourself this one absolutely critical question. Will FY27 finally deliver on that massive 1336 crore promise, or will execution delays strike again and burst the valuation bubble? Thanks for joining us for this explainer today.